Happy Thursday out there, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Thursday, October 27th, 2022. So starting with our economic release spotlight. So it's all eyes on Q3 GDP with a P. So obviously the number came in better than consensus. We're seeing an acceleration on a quarter-over-quarter basis from Q2. Very clearly not in recession. Obviously, we talked about this all year on the program. Don't confuse a technical recession with a 42 macro hashtag actual recession, which again is more akin to what the NBER, which is the National Bureau of Economic Research. That's the committee that sort of dates recessions, usually on a very severe lag to the actual occurrence of these events. But what you're looking for an actual recession is a broad-based decline in economic activity that spans across, consumption, production, income, employment. It's pretty obvious, it's pretty ubiquitous, and it's very obvious and ubiquitous that none of that stuff is happening now. So let's just go down and read some of the numbers off the headline. So we were flat on a year-over-year basis at 1.8%. We accelerated on a quarter-over-quarter basis, 320 basis points to 2.6%. That's the fastest rate of growth we've seen since Q4 of last year. Personal consumption expenditures in terms of the contribution ticked down a little bit, only contributing 100 basis points to growth this quarter, down from 1.4 in the previous quarter. That was sort of depressed by a slowdown in the contribution of services consumption, only contributing plus 120 basis points to growth this quarter, which is down from 200 basis points in the prior quarter. Obviously, there's a lot of stuff contributing to upside here, not the least of which is non-residential fixed investment, which is business investment. That's contributing 50 basis points to GDP there on an absolute basis. Net exports, really big swing in our favor, contributing 280 basis points to the overall number. And then you had some big G into the midterm elections as well. So government consumption expenditures, in terms of that contribution to the headline figure of 2.6%, we accelerated 70 basis points to 40 basis points in terms of the contribution. So it's pretty good from a growth standpoint. It's not the best report, but again, we're in the middle of a cross-asset bear market. This economy's been slowing for well over a year now, and it's likely headed for a hashtag actual recession at the end of the rainbow. It's just that the end of the rainbow is nowhere near today in terms of respecting the x-axis. We had some summarizing from the GDP report. We, on the inflation side of things, had a very positive shock to the downside on headline inflation. If you look at the implicit price deflator, that slowed 500 basis points quarter over quarter to 4.1%. These are quarter over quarter annualized figures. That's the lowest print we've seen since Q4 of 2020. And then you actually had the core PCE price deflator decelerate 20 basis points to 4.5%. On a quarter-over-quarter annualized basis. That's the lowest print we've seen since Q1 of 2021. So in summary, I think a lot of the GDP bears, without models, and again, I think we have some of the better models out there that I've seen on a lot of this stuff. They're wrong. The U.S. economy is not in recession. The U.S. economy is booming from a coincident to lagging economic indicator perspective. This are all things that we talked about in 42 macro research all summer. We gave some conclusions on that on Real Vision yesterday. So definitely go check out that Real Vision daily briefing that I did with my buddy Andreas Larson yesterday, where we sort of presaged a lot of what we're seeing on our screens today. Transitioning, getting into my longbow dashboard, where we're going to briefly touch on what's happening in global macro, and then conclude with some tickers that are signaling either overbought or oversold, that you can sort of establish some positions in for all my tactical traders out there who are watching the program to make and save money, because that's what we're here for. We're not here to pontificate about GDP. We're here to contextualize what GDP means as it relates to your investments. And oh, by the way, I don't think the Fed is going to pivot with an above trend growth rate in the U.S. economy. Bada bing, bada boom. Anyway, so going back to my longbow dashboard, maybe I should quit my day job. Bloomberg dollar, that is bullish. It's getting oversold here. So this is the signal you don't want to see if you are, YOLOing, right tail risk at this juncture, hoping to play for a year-end Santa Claus rally, and we may get that, we may not get that. I'll leave my thoughts on whether or not that's a high probability outcome for 42 macro subscribers. But just in the context of the very immediate term situation, this dollar getting oversold here is not what you want to see. Now, the one thing I will say is we're seeing a material widening of the trading range with respect to the US dollar. And in addition, with that material widening, we're seeing the lower boundary of the range also expand to the downside. So maybe not want to be in a hurry to press risk asset shorts, buy the dollar, et cetera. Give this some time to breathe. Just let it cool. Again, as I mentioned, there are a lot of very interesting cross currents from a macro perspective, a micro perspective, flows perspective. The flows are a little bit less supportive than they were when we called it out last week, saying, "Hey, look, we're going to see some positive flows." Actually, no, I think that was not last week, but it was the week before last in our Around the Horn report. Those flows are less supportive. The macro is to be determined. We get the employment cost index tomorrow. We get the PCE report tomorrow. Then obviously we continue to get data throughout the rest of the month. And then obviously you have the FOMC next Wednesday. You have the midterm elections the Tuesday after that. There's a lot of poop coming at you, for lack of a better word. We'll keep it PG. So it's a lot going on. And then, oh, by the way, the micro, we got Apple and Amazon reporting earnings after the close today. So let's hope. Let's hope for the sake of the YOLO call bulls, the zero time to expiry options community. Let's hope that they're not overly long calls here into that. If we see a negative print, we're not going to forecast that. But anyway, getting back to my Longbow dashboard, gold is same setup with gold that we've been talking about for the last few weeks. Bearish, middle of the range, 10-year Treasury yield, that's bullish. Getting towards the lower boundary of the range there, not quite. S&P, that's bearish, medium term, bullish, short term. Upper boundary of the range continues to expand for the broader market. That's exactly what you see. So you don't need to be in a hurry to press shorts there. The same signal with the VIX to the downside as we saw with the dollar. The lower boundary of the trading range continues to expand to the downside. So you don't need to be in a hurry to be allocating to put premium at this particular juncture. Bitcoin, Ethereum, same dynamics as we talked about yesterday. Overbought, both bearish from an immediate term or from a medium term perspective, bullish from a neutral from a near term perspective. Upper boundary of the range is expanding again. When you see that range start to move, it's telling you that there might be some changing volatility conditions, because again, the width of these ranges corresponds to the volatility regime of each of these individual markets. And so once you start to see that range expand, it could be a leading indicator for a phase transition in medium-term price momentum, or it could just be a sort of a tactical, immediate-term thing that's happening. We've seen this movie play out several times throughout the year. Some people are adept at trading that and can trade that. Most people are not. And so to the extent you are in the latter category, definitely be careful not to conflate some of these tactical moves in markets and flow-driven, positioning-driven moves with a real change in macro fundamentals, because again, that's what's really driving the bus here. Shanghai Composite, bearish, still bearish in the middle of sorry, that's been bugging me for the last minute and a half. 0 days to expiry is 0 DTE. I knew I was saying that wrong. It's 0 days to expiry. That's Brent and I, Brent, Imran, and Tony Greer and I actually talked about that in our Macro Avengers podcast series, which will be out this morning, actually. So definitely go check that out. Another one of those fantastic overviews of global macro from both the top-down and market microstructure perspective. I think that's an excellent community, excellent group of guys, and I always look forward to doing that discussion. So I learned a lot, and you'll definitely learn a lot. So check that out today. Anyway, getting back to crude oil, that's still bearish, getting towards the upper boundary of the range, neutral on a short-term basis. Same thing with ag, same thing with industrial metals. So we talked about in this program, if oil bottoms after POTUS is done leaning on it from a strategic midterm reserve perspective, riddle me this: are we going to have positive developments on the inflation front over the next few reports? If we have adverse developments on the inflation front of the next few reports, are we going to get a Santa Claus rally that's driven by flows? I keep hearing that, but I don't hear anybody with that view say anything about inflation, say anything about the Fed. They just backfill that and say, well, I guess the Fed has to pivot to support my view. And maybe that is the case, but that's, in our opinion, a very dangerous way to invest. That's usually how you blow up when you sort of only anchor on one leg of the stool. At 42 Macro, we always try to anchor on all the different legs of the stool. When they're all grounded on the floor, we know what we need to do. And when sometimes one leg of the stool is not on the floor, one tire is not on the road, then you do less. If all the ducks aren't lined up, then you don't need to act. Some people need to act, institutional investors, namely, and we try to do our best to help them do at least do our quantitative and qualitative analysis, but that's neither here nor there. Getting into my global macro dashboard, where we are sorting 300 global macro exposures with the odds tab here, or the odds column here, to give us a sense of what's most overbought versus most oversold. You got, let's see, I want to get something juicy here. Something juicy. Our buddy talked about Bitcoin already. Yeah, it's not much too juicy. There's a lot of stuff on the commodity producer side, natural resources, pick, silver miners, etc., oil and gas equipment servicers. These things are all getting towards overbought. And let me guess, at the bottom, we'll probably see some things that look like, sorry, did I even sort this thing? I'm an idiot. Yeah, we'll probably start to see some things that actually look oversold here. So VIXY, CTA, crash protection, midterm VIX futures. These are, the market is now assigning a discount to downside, to the left tail risk that we very much clearly see still existing in the marketplace, just given the dynamics that we have ahead of us on the macro catalyst calendar. So be careful out there, my friends. This is Darius Dale presenting our Macro Minute for Thursday, October 27, 2022. Now, we might have ran a little long this morning, but I'm sure you're not too pissed off about it because, again, we're giving you free alpha here. Let's catch you back here tomorrow. Cheers.